$15 billion. One man, one trade, 1 year. While millions of Americans lost their homes, their savings, their retirements, this man made $15 billion. He wasn't a genius. He wasn't an insider. 2 years before, Wall Street had never heard his name. They laughed at him. The biggest banks in the world told him he was wrong. His own investors tried to pull their money out. He didn't move. You watched The Big Short. You know Michael Burry made hundreds of millions. What they didn't tell you, what the movie never showed, is that there was another man at the table. A man who made 15 times more than Burry. A man who pulled off the single greatest trade in financial history. And almost no one knows his name. Until now. It is 2004, New York City. John Paulson takes the bus to work. Not because he can't afford a car. He can. His hedge fund, Paulson and Company, manages over $1 billion. But Paulson is not a man who wastes. Not money, not time, not words. On Wall Street, nobody takes him seriously. He is a merger arbitrage specialist, a technician who makes small, careful bets on corporate deals. Reliable, predictable, boring. He is not George Soros. He is not Warren Buffett. He is not the kind of man who appears on magazine covers or gets invited to dinners with senators. He is the kind of man who reads data. And in 2004, something in the data doesn't add up. Across America, banks are handing out mortgages like candy. No income verification, no down payment, no questions asked. Families with no savings are buying houses they cannot afford, on loans that will reset to rates they can never pay. And those loans, millions of them, are being bundled together, stamped with the highest possible credit rating, and sold to investors around the world as safe, as guaranteed. John Paulson reads this and feels something cold move through him. Not excitement, not greed, fear. By 2005, Paulson is obsessed. He hires analysts. He orders them to read individual mortgage files, not the summaries, not the ratings, the actual files, one by one. What they find is staggering. Borrowers with no jobs. Borrowers who listed their income as zero. Borrowers who owned 5 properties simultaneously, all financed with no money down. And yet every one of these mortgages had been approved, packaged, sold. The system wasn't just fragile, it was fraudulent. Paulson begins to ask a question no one else is asking. What happens when these loans reset? What happens in 2 years when millions of families who can barely afford today's payment suddenly face a rate that doubles? The answer is obvious. They default. And when they default, those beautiful AAA-rated mortgage bonds, the ones pension funds and banks around the world are holding, become worthless. The entire architecture collapses. Paulson sees this with absolute clarity. But clarity alone is not a trade. He needs an instrument, a way to bet against something the entire market believes in. Then he finds it. Credit default swaps. Think of them as insurance policies. You pay a small premium, and if the mortgage bonds fail, you collect. Massively. The beauty of it? The premiums are cheap, because no one believes the bonds will fail. No one except John Paulson. Paulson begins shopping his idea to anyone who will listen. Goldman Sachs tells him he's wrong. Bear Stearns tells him he doesn't understand the market. His own investors tell him to stick to what he knows. One meeting at Deutsche Bank, a senior executive laughs in his face. The housing market has never had a nationwide decline, he says. It never will. Paulson still walks out of that meeting and does something his peers consider madness. He doubles down. By 2006, Paulson and Company has raised a dedicated fund, the Paulson Credit Opportunities Fund, specifically designed to bet against the housing market. He pitches it to institutional investors. Most refuse. Some mock the very premise. One investor calls it the stupidest idea I've ever heard. Paulson doesn't argue. He doesn't get angry. He goes back to the data. And the data never lies. While he waits, the housing market soars. Prices rise. Wall Street bonuses hit record highs. The party, everyone agrees, is just getting started. Paulson is paying premiums on his insurance policies every month, losing money. Slowly, steadily. His investors begin to panic. Some demand their money back. He didn't move. February 2007. A small item appears in the financial press. Delinquency rates on subprime mortgages are rising. Slightly. Barely worth mentioning. Paulson reads it at his desk and feels his pulse quicken. It begins. By spring, the cracks are widening. Two Bear Stearns hedge funds, both heavily invested in mortgage bonds, begin to collapse. The bank tries to contain it, issues reassurances, tells the market everything is fine. Everything is not fine. In June 2007, those two funds are wiped out entirely. $1.6 billion. Gone. The market shudders, then steadies, then shrugs. But Paulson doesn't shrug. He watches his credit default swaps begin to rise in value, slowly at first, then faster. In the summer of 2007, his funds post a single month of returns that Wall Street has never seen before. 66% in 1 month. The phone calls start coming in. The same investors who mocked him, the same bankers who laughed. Now they want to know, how did you see this coming? He gives them the same answer he's been giving for 2 years. I read the data. By the end of 2007, John Paulson's flagship fund has gained 590%. His second fund, 353%. Total profits for Paulson and Company, $15 billion. For context, George Soros made $1 billion breaking the Bank of England in 1992. That trade became legend. It is still taught in business schools. It is still written about in books. Paulson made 15 times that in a single year. Personally, Paulson takes home nearly $4 billion, the largest single-year payout in the history of Wall Street. More than Oprah Winfrey, more than Tiger Woods, more than most countries' annual budgets. And outside of financial circles, almost no one has heard his name. Meanwhile, the world burns. Lehman Brothers, one of the most powerful investment banks in history, founded in 1847, files for bankruptcy on September 15, 2008. It is the largest bankruptcy filing in American history. Paulson had bet against Lehman. His $22 million position pays out over $1 billion. a return of $45 for every $1 invested. Across America, the consequences land on ordinary people. 9 million jobs disappear. 8 million families lose their homes. Retirement savings evaporate overnight. The crisis spreads to Europe, to Asia, to every corner of the global economy. The total damage? Over $20 trillion. John Paulson makes another $5 billion in 2008, betting against the financial firms that are collapsing around him. He is not celebrating, not publicly. He is a man who watches, who calculates, who knows that the blood in the water is real, and he does not romanticize it. After the crisis, the question comes. It always comes. Was John Paulson a visionary or a vulture? He didn't cause the collapse. The fraudulent loans existed before he arrived. The reckless banks, the captured rating agencies, the captured regulators, they built the machine. He simply read the machine and placed a bet. But here is what stays with you. For every dollar Paulson made, someone lost a home. Someone's retirement disappeared. Someone's small business closed. The math is not abstract. It has faces. He would say, and has said, that short sellers like him serve a function. They identify weakness in the system. They apply pressure that forces reality to surface faster. Without them, the bubble inflates longer. The crash, when it comes, is worse. There is logic in this argument. There is also $15 billion. The uncomfortable truth is that markets are not moral. They do not reward virtue. They reward accuracy. John Paulson was accurate. More accurate than every bank, every regulator, every economist who called the housing market safe. And he was rewarded accordingly. History has a sense of irony. The man who made the greatest trade in financial history would go on to make some of the worst. In the years after 2008, Paulson bet heavily on a gold boom. He was early and wrong. His funds lost billions. He bet on a recovery in European banks. Wrong again. By the mid-2000s, investors who had once begged to give him money were withdrawing it. His fund, which once managed $38 billion, shrank to a fraction of its peak. In 2020, John Paulson converted Paulson & Company from a hedge fund to a family office, managing only his own money. The era was over. He had made his fortune, the greatest fortune from the greatest trade in the shortest time. And then he was human again. What do you do with a story like this? John Paulson didn't invent the crisis. He didn't break the housing market. He looked at the same data everyone else had access to, and he saw what no one wanted to see. That is the lesson, and it is uncomfortable. The information was always there. The fraudulent loans were public record. The rising delinquency rates were in the reports. The misaligned incentives were visible to anyone who looked. Most people didn't look, because looking when everyone around you is celebrating requires a particular kind of courage. The courage to be wrong, publicly, for years. The courage to hold a position while the world tells you you're an idiot. John Paulson had that courage, and history rewarded him with $15 billion. Whether you call that justice, irony, or simply the brutal logic of markets depends on where you were standing in 2008. If you were on Wall Street betting against the world, you won. If you were the world, you already know how that story ends. Every fortune has a price. Was Paulson a visionary who saw what no one else would admit, or a man who built a fortune on other people's ruin? I've told this story without taking sides, but I'd love to hear yours in the comments below. If you enjoyed this story, subscribe to Golden Ruin. Every week we tell another one, the financial moves that shaped history and the men who paid the price. I'll see you next week.